Which brings up an interesting point about accounting. And we were talking from the beginning about accounting as if it's one science. And there is a foundation there. And most of the accounting we have talked about to this point is financial accounting. It's what organizations use to present their financial statements externally to organizations outside themselves. It's a requirement. The format we looked at for the income statement, revenues minus cost of goods sold, gross profit, etc., are all financial accounting. That's fine. That's how financial statements are prepared. But what we also want to be aware of is managerial accounting is what we use internally within our organizations. Total revenue, total expense is the same. We're not talking about different numbers. What we're talking about and the difference between financial accounting and managerial accounting is the different terminology we're using and the different ways, different places we put the costs. Not going to change the totals. This is not going to change the bottom line. It's just a different way to look at our costs. And why do we care? We care very specifically because in financial accounting, we're following the traditional accounting approach to present financials externally. And in many cases, the people who are reading those financials are not going to dig into every single line item or even care to understand them. They're looking for specific things, and we're following those guidelines. But in running an organization, we'd like a deeper understanding of our own numbers, specifically our own costs. What managerial accounting does for us, and you can see this in the spreadsheet, is give us more precise terminology. So when we covered break even, we talked about fixed cost and variable cost. That's managerial accounting. Financial accounting, revenue minus cost of goods sold is gross profit. In managerial accounting, revenues minus variable costs will give us contribution margin, minus fixed costs gives us our operating profit. It's more precise, it's more exacting. It's what we use internally to make better decisions for managing our organization. And here's your example. On the left is your financial accounting. There's your revenues of 100. You'll see in both cases, left and right. Revenue's the same, that's your top line. Net income is the same, that's your bottom line. Financial accounting, we have revenue of 100 minus our cost of goods sold of 75 gives us our gross profit of 25. Tying this back to our ratios, divide your 25 by your 100 of revenue, tells us that our gross profit margin is 25%. There's a basis of comparison. We've got operating expenses of 20, operating profit, also known as our EBIT, of 5. Post-tax adjustment, post-operating profit adjustments of 4. There would be your interest and your tax to get us to our net income. Same organization internally, because what we've reported externally is on the left. The right-hand column tells us inside our company, for the same revenue, what amount of our cost varied in direct proportion to our revenue. That's our variable cost. What contribution margin was netted? So we have a 38% contribution margin where we have a 25% gross profit. That just tells us that part of our cost of goods on the left really weren't variable, but financial accounting didn't allow us to separate those out. Our managerial accounting says what amount of our cost varies in direct proportion to our revenue. That's our variable cost. The difference between that and revenue is our contribution margin. What amount of our costs are truly fixed for the period of operations gets us to our same operating profit and bottom line. So you can see the differences. We use different terminology and we calculate the precise costs in managerial accounting where they're slightly more estimated in financial accounting. Managerial accounting is what we use internally so we can make better decisions and manage the organization better. When you're doing financial analysis of a company, if it's a company other than yours, you're probably going to have the financial accounting numbers. If you're analyzing your own organization and have access to the managerial accounting numbers, you will be more precise in your analysis, which will probably give you a much better picture. The last segment we have in this module is revenue recognition. This is the area that in the last couple of years has created a lot of discussion, because we all have assumed for many, many years that revenue was revenue. You recognize revenue under accrual accounting when you made a sale. But we've seen so many situations over the last several years where there really is a question. Was there a sale? Was there not a sale? Well, when an organization makes a sale, they're supposed to recognize the revenue on the income statement. They're not supposed to recognize the revenue before the sale is completed. And that always is the real challenge. Well, what accounting has tried to do is be very clear on defining when revenue can be recognized. When does an organization actually have the right and the obligation on the income statement to recognize revenue? So they've come up with a 5-step process. And the real reason here is some organizations have chosen to recognize revenue, in other words, add revenue to the income statement that has not actually occurred appropriately. That would inflate the income statement in the current period, even if it would hurt the organization in the future. That's why this is so important. So the 5-step model says, can we identify the actual obligation with the customer? We have a customer, they've said, yes, we'll buy X, whether it's a product or service, whether it's a written contract or purchase order or agreement or something else or not. Can we identify that if we need to? Number one. Number two, we have to be able to identify the performance obligations. This sometimes is the gray area. What needs to be done by the seller and the buyer to make this an actual sale? Think of software. If you're selling me software and I don't have the key, I can have the software on a disk. I can have the software in my server and still not be able to use it. If I can't use it yet, I have no obligation to pay for it. You cannot recognize it as revenue. Number three, determine the transaction price. Again, if there's some paperwork, purchase order, contract, etc., that should be very clear. But it must be documented as to what the actual transaction price is, whether it's a single transaction or progress payments, a series of installments, and what are the terms. Then the allocation of the transaction price. This has more to do with installments or sequences of payments than a one-off. If I'm performing service for you over 3 years, then even if I collect all of the revenue up front, I have not earned that revenue until I've performed each of the steps of the agreement over the 3 years. So it must be allocated appropriately over that term. And number 5, revenue recognition when all obligations on both sides of the transaction are performed. If you as the buyer or me as the seller have not performed what the contract calls for, the transaction is not complete. You have no obligation, I have no revenue recognition. And these 5 steps were created by both the International Accounting Standards Board, the basis of IFRS, and Financial Accounting Standards Board, the basis of GAAP, because so many large organizations had gotten into transactions that they weren't sure were complete or not. Therefore, financial statements were on occasion misstated. On occasion, they were put together incorrectly and had to be subsequently restated. That's what we need to know at this point on financial analysis. I hope as we went through each of these items, from our ratios to our operating and cash cycles, to our make versus buy analysis, to the Altman Z-score, to the different ways we look at inventory, to comparing our financial accounting to managerial accounting, and finally our revenue recognition. I hope this gave you the basis, the foundation of beginning your financial analysis and getting ready for forecasts and budgets, which we'll look at in the next module. Until next time, this is Daniel Feynman.